Thank you, everyone, and our friends at ShareSwap for hosting us today to talk about Latin America. It's a fairly brief presentation, as Mike said. Please ask lots of questions in the middle. And sorry if I'm a bit narrower than normal. I guess it's always good to be narrower than wider than normal, at least from my perspective. So please ask questions. We're going to go through the deck, but do interject as we do it, because there's only one thing more boring than listening to me for 25 minutes, and that's listening to me for 55 minutes. And really, that won't be very helpful. So we go to the first slide, please, which I said for the technical reasons, hopefully you can see, but I currently cannot.
Yeah, it's all, I can see it loud and clear, if that's the right description.
Right. Okay. That's good. So hopefully, right, you can see that slide. Great. So this is a description of the people managing the fund. There shouldn't be any surprises. Myself and my fund manager, Chris Brinkman, we've been managing this fund for a few years. To be clear, it's not the 2024 has not been a vintage year for Latin America, but here's just a brief summary of what we have in the fund and the structure of the fund. Let's go to the next slide. It gets a bit more interesting, hopefully. Not that slide. As a reminder, what the story about emerging markets in Latin America specifically is, there's sort of a very high degree of complexity. We're looking across a range of countries. People talk about Brazil and Mexico, but it's also Chile and Colombia and Peru and Argentina and Ecuador and Guyana and Panama and Costa Rica and all sorts of places I'm going to talk about over the next few minutes. It's a rather big range of countries with their own peculiarities. They are very volatile. The big difference really between emerging markets, especially in this part of emerging markets, and what one's used to investing in the UK, is that sort of 80% of stocks move 40% or more every year. One has to embrace the volatility. If one cannot embrace the volatility, one is going to get very scared and one's going to make bad investment decisions. So people interested in Latin America have to have a high degree of risk tolerance, and they also have to be able to invest for a medium-term time period. It is not a good idea at all to be investing in Latin America with a 3-6 month time horizon, because something will happen that scares you during that period of time. So one has to have a medium-term time horizon, especially given the volatility of these markets. And of course, this level of volatility also creates a degree of dispersion, so that these markets aren't that correlated. So when Brazil's going up, Mexico could be going down and Argentina could be flat, or Peru could be going up and Chile down. Lots of different things happen in these markets, and that creates opportunity for alpha. If we go to the next slide, please. As a reminder to you today, we have a collection of analysts who look at stocks across the region. We have a combination of a top-down and bottom-up process. So we don't just look at the company fundamentals and meet companies and their customers as suppliers and competitors, which of course we do, but we also have a view on the politics, macroeconomics, fixed income and currency of all the countries we invest in. As a general rule, if there is something wrong with the currency, if we think there's something wrong with the currency, we really don't want to have too much exposure to the equities, because typically, not always, typically in these markets, when the currency goes down 10%, the market goes down. When the currency goes down 10%, the market goes down 20%, and one loses 30% very quickly. And it's important that we have style flexibility. Many in emerging market fund manager, many a Latin American fund manager struggles because they get tied into the same story and tell people we love Brazil or we love high growth companies in Mexico or whatever it is. And when the market style changes, it's a very difficult situation. So we have style flexibility. We aren't ruling out any types of stocks or any types of markets, providing our compliance department allows them. Let us go to the next slide, please. And one more. So this slide shows optically very big exposure to Brazil and Mexico. And there's really two reasons for that. One, they represent a very large portion of the opportunity set, but far more importantly, and this is a very heavily Brazil-Mexico exposure today, much more than normal. And that's just because these markets are outstandingly cheap today compared to the histories, compared to the rest of emerging markets, as we will see in a few minutes. and also because the current perceptions of these markets is almost uniquely bad. It would be interesting, perhaps, for people to know on this call that I've been doing this job for just under 25 years, and compared to the United States, as did Mexico. So the two biggest markets in the region have hit an all-time relative low yesterday. Doesn't mean they won't hit further lows today, although given what markets are doing, it's unlikely. But it's really interesting. The extreme of bearishness, the extremities of negativity, pessimism about this region is kind of unprecedented. Hence, they've hit relative lows. And so we have very big exposure to Brazil and Mexico. But if we go to the next slide, please.
And we have got a question
Yes.
now on that particular aspect of volatility for the Latin Americans. For you, Johan here wants to know, does volatility really mean, I think he means, risky investment for a long-term investor? Or is it something that you shouldn't worry about if you're a long-term?
No, one has to. Volatility means that, let us say, and these are rough numbers, in the UK, on an average day, let us say the FTSE moves 50 basis points. On an average day, when one thinks about returns on a dollar basis, it's more likely Brazil moves by 1%. And those aren't exact numbers, but it means on any given day, the index you look at or the stocks you look at are just going to move by a bigger number, up or down, in Brazil or Mexico than they would do so in the UK or the US. So that means if on an average day they're moving by, let us say, 70 basis points or 1%, sometimes they're moving by 2 or 3 or 4%, and many stocks may be moving by 5, 6, 7 or 8%. And this happens on a fairly frequent basis, which means if one doesn't have a strong stomach, one can look at the portfolio and go, oh my gosh, things are terrible today. Or, oh, brilliant, things are wonderful today. And the next day, they are the reverse. So it really means this degree of volatility that we have in Latin America means one really has to take a long-term horizon, because one can very easily panic when one sees a few days where there's an announcement on a political nature or something else. And it's really, really important one can take a medium-term view or a long-term view, even better, and not be beholden to what one sees on a daily basis.
In which case, the risk is sort of mitigated to some degree if you're thinking long term. Yeah. Okay. So I think that's kind of, you're sort of thinking along the same lines as Johan there. But in the long term, of course, you'd still want your investment trust to show a growth in the asset value. Otherwise, they're in the long term, it's not going to work either, is it?
That's totally true. As one famous man said, in the long term, we're all dead. Hopefully we'll see asset price rises over the medium to long term. It just happens to be that perhaps we are at a unique low in these asset prices today. I think people sometimes forget that cyclical asset classes go in and out of favor. So today everyone's very excited by US and technology. People forget that for the period, let's say, which isn't too long ago, between 2000 and 2012, technology stocks in the US did appallingly, right? The SOX, the semiconductor index, went down over that period of time. And in fact, I think I'm right in saying it went absolutely nowhere, or actually down over that period of time. And I think it had 3 or 4 falls of 40% at an index level over that decade. So today it's everyone's flavor of the day, just as emerging markets, just as Latin America was perhaps a decade ago. So sometimes people have this tendency to remember the near past and forget about the slightly longer time horizons. So it's totally true that Latin America has been a really poor investment on a relative basis in 2024. That does not mean it's going to be a really poor investment in 2025. And far from it. I would say that if one buys something cheaply, the chances of it going up are considerably better than buying something that is expensive.
Okay, thanks for that. We've got some more questions coming here before we move on. Paul Taylor wants to know, how impactful do you think the Trump tariffs will be on these markets?
A very fair question, and it's a question lots of people are asking today. I think the key question for any investment at any point is what is already priced. Lots of people have been talking about Trump getting elected, and then obviously he has been elected, and his impact on the Mexican economy specifically, which is likely to be much more impacted by any tariffs than Brazil. So my guess, my feeling, my strong feeling is that a lot of the bad news is already in the price. So people are aware of Trump's views on tariffs. They are aware that he would like to place tariffs on certain goods in certain countries. I would just say that from a political perspective, I think he's much more likely to place tariffs, meaningful tariffs on China than on Mexico. There is, of course, a free trade zone between Mexico and the US, which means placing tariffs is difficult. And even if he wanted to, it's not clear to me that the Senate would actually pass tariffs on Mexico. So I think what we're looking at is Mr. Trump wanting to get a deal out of Mexico on immigration, on trying to curtail the movement of drugs, and on crime. And I think sort of making tariff noises is one of the ways in which he wants to try and get a deal. He is, of course, a man known for the art of the deal. So I think technically, when it comes to tariffs, we're likely to see tariffs on China. We may see some small tariffs on Mexico, but I don't think that really derails the Mexican story medium term, especially, as I was saying earlier, when this has been discussed quite heavily over the last 6-12 months, and not just the last, 4 weeks since the election, and therefore is likely already in the price.
Okay, thank you. Another one here from Peter. Is there an investment case for Brazilian stocks at all? Or do you think that prospective returns for stocks is going to be greater than that?
Thank you. I think the gentleman's name was Peter, was it? I think
Peter, yes, Peter.
Thank you, Peter. That's a superb question. And that is exactly why so many people in Brazil have been dumping stocks over the last 12 months. Lots of domestic players in Brazil have had exactly this view. Why now should I own any stocks when I can get 13% risk-free? And that explains very substantial outflows in retail funds, mutual funds in Brazil over the last 12, 18 months. Some of the most substantial outflows we've seen ever. But the question is not where we are today. The question is what is likely to happen going forward. And the reason why Brazilian rates are so high, and remember inflation a year or so ago. So Brazilian inflation isn't so high, but rates are very high. In fact, real rates, as they're referred to, the difference between the amount one can get on government bonds and inflation at 8-9% is amongst the highest it's been, again, in my career. So my guess would be that in a couple of years' time, and one has to take a medium-term view, rates will come down in Brazil, even if they go up a little bit in the near term. And that could usher in an almighty bull market because the companies in Brazil across a range of sectors are actually doing really well. And if you look on this chart, which we actually moved to earlier, you can see our exposure is really across a range of different sectors in Latin America, and specifically domestic stories in Latin America, in Brazil, are actually doing quite well. So we have an interesting environment in Brazil today where unemployment is pretty much at a record low. Economic growth is actually surprising on the upside. Corporate earnings are surprising on the upside. Inflation isn't very high, yet rates are extremely high, as you, Peter, highlighted.
Right, thank you. Joanna asked a sort of similar question, really, are you worried about the overweight in Brazil for the currency risk, the political risk, and the intercompany correlations across businesses in Brazil? There's a little bit more to that question, but it's a similar parallel to the one you just answered. Did you want to add any more?
That's a very fair question. I'm always worried about all our investments. That's the nature of fund management. It would be very strange if I didn't. But obviously, there is no such thing as return without risk. So every single day I wake up worried about Brazil, what the politicians may say or do. But at the end of the day, I think about the return and not just the risk. So I am worried. But actually, the economic setup in Brazil isn't that bad. The fiscal situation isn't great, and they're perhaps spending some money they don't have. Not a unique story to Brazil, it should be stressed. A fairly common story in much of the Western world, in the US, the UK, and in the EU, but people pay much more attention to it in Brazil. So I am concerned, but I think given how lowly the currency is at an all-time low, pretty much around 6 to the dollar. And how cheap the market is, I would hope, and I would suggest that a lot of that bad news is already in the price.
Okay, thank you.
So if there are no further questions at this stage, I'll just highlight this slide here where you can sort of see our exposures, very broad range. Can't say it's exactly equally split across the sectors, but it's a pretty colorful circle here. Our big focus is really on domestic stories because that's where we see the greatest earnings growth over the upcoming period. If we go to the next slide. Here's just a list of our largest stocks. Some of them may be familiar to people, others not, but they're really across a range of different sectors, principally in Brazil and Mexico. As I said earlier, we've often had many stocks outside Brazil and Mexico. And in fact, this year, I have taken the time to go to Guyana, perhaps more famous for cricket than for being the world's fastest growing economy, going to Panama, perhaps more famous for its canal than for a potentially massive copper mine and a range of other activities, to Ecuador, famous currently for some of the violence, but also with enormous untapped wealth in the material sector. And we've had, during the course of the year, exposures in all of those places. And it's about finding the right time to enter and exit those markets. So many of these stocks are in Brazil and Mexico, but rest assured, we are very excited by the opportunities across the entire region. If we go to the next slide.
Sam, just before we get to that one, just one from me, actually. You mentioned on the first slide, I think it was, the target tracking error. I wondered if you could just expand on that. I think, what are you tracking against, and are you and how are you doing against that, and why did you set those targets?
That's a very fair question. So we measure ourselves, although we want to have absolute returns for our clients, but we do measure ourselves against the reference index, and that's the MSCI Latin America Index, MSCI being a large index provider. So it's a bit like measuring ourselves against the FTSE in the UK. It's the most relevant index for Latin America. And the tracking error is the extent to which we will be different from the index. So we try to ensure that on a risk-adjusted basis, we're taking sufficient risk to generate meaningful returns, but not such aggressive risk that our returns are going to bear no relationship to what's going on in Latin America. So
you are trying to follow the index as such to some degree, but you're in danger then, therefore, of becoming a passive if you're not careful, aren't you?
We're not following an index. It is a measure. We're absolutely not. We build the portfolios bottom up, but this is what we are measured against, right? It would be very strange, as it were, to measure us against the FTSE because that's not the opportunity set, or some other index. So this is a reference index so that people can judge whether we've done, over a medium-term basis, done a good or a bad job, rather than something that I sort of say, I want to be 2% overweight Brazil or 3% underweight Mexico. That's not how we think about the stocks that we invest. We're looking for interesting ideas across Latin America, but we have to try and do that within a risk control framework, because otherwise the returns that we would generate would bear very little relationship to the asset class that our clients think they're investing in.
So to what extent does that drive your transactional strategies then, and to how often you churn the portfolio?
Yeah, so interestingly enough, this year we've had fairly low turnover by historical standards. I think from memory, it's sort of been around 45-50%. I think that was the data to the end of October, not to the end of November. And that really reflects the fact that we're very comfortable with the positions that we have, but they definitely haven't worked this year. So our tracking error has no bearing really on our transactions. We buy and sell stocks when they look very cheap to us, or when we sell them when they hit our target prices. So the tracking error has very little impact on our transactional activities at all. What's critical for us is that we see interesting opportunities. We're going out to see these companies. We find really exciting investment opportunities across a range of sectors. And what's even more important, other than finding these opportunities, is having the discipline to sell them when they hit our target prices. We do not fall in love with any of the companies we invest in, nor do we have a sense of perpetual hate towards any stocks in our world. And that's actually quite important to have that discipline, because as we started off, these markets are volatile, things can change, and it's really, really important to have both a buy discipline and a sell discipline.
Okay, thanks, Sam. We have some more questions coming in while you were answering that one. This is again from P2's. Thank you for answering his previous question. How would you rate the policies of the new government in Argentina? There seems to be some improvement in CPI, car and home sales, and consumer sentiment. How do you or investors could play this potential recovery play?
Yeah, it's a really interesting point. I think people forget that in 1919, so just over 100 years ago, Argentina was the third richest country in the world. And for much of the subsequent century, it's gone backwards on an absolute and a relative basis compared to everywhere else in the world. I mean, they've won a few World Cups over that period of time, but economically, the management of that country has been poor, very poor, or truly exceptionally poor over that much of that period of time. Javier Milei was elected just over a year ago with a mandate to change things, and he's definitely changed things. What's very interesting is a year ago, lots of people sort of perceived him as a strange character. They made all sorts of very derogatory comments. Look at the BBC website for a list of derogatory things that people said about this elected president, because he didn't come from the right part of the political spectrum. He didn't say nice things about various accepted truths, and he challenged the accepted wisdom about Argentina, and therefore he was given a very hostile reception by people in the media, especially in the UK, in Spain, and other parts of Europe. That said, he did have a very clear mandate from the people in Argentina, who actually matter a lot more than a random BBC journalist. And so he has made some very significant changes in the country. As the questioner highlighted, inflation has begun to drop back. They cut an enormous amount of government spending, and the stock market has rallied like we did have exposure to Argentina early on in the year. After the market rallied fairly strongly, we cut that exposure because we are aware that while Mr. Milei is doing some very good things, reversing 100 years of decline is not something that is very easy to do in the course of 6 months. And while many of the steps he's taking are sensible, not necessarily all of them in the future will be. So the market, as I said, has done extremely well, and that always gives us pause for concern. But definitely, we've been impressed by what Mr. Milei has done. I'm about to sneeze, so excuse me. Sorry about that. Thank you. We've been impressed by what Mr. Milei has done, and we were always slightly more positive than the very, very derogatory and almost spiteful comments made about him in the Western media a year ago. And I think he deserves a degree of applause for what he's actually achieved. I think the second year in office may actually be a lot more difficult for all sorts of reasons than the first. We look forward to having more exposure to Argentina, but not sure that this is the best time to be adding there.
Okay, thank you. Michael wants to know if you could show us a longer-term performance chart of the trust versus the benchmark and the emerging markets and the S&P indices, please.
Yeah, I unfortunately, I can't actually put up a chart now.
Have you got one in the pack anywhere?
We don't have one. I can tell you it would look pretty horrible. I can tell you that straight out. The longer term performance of Latin America, as I said, would hit an all-time. So against the S&P, it would look pretty horrible. So I think it was one of those who said it would hit an all-time relative low. So it would look horrible against that. It would probably look horrible against the FTSE. And definitely the last year has been very challenging for us against our own index. We've got a lot of things wrong in the last year, specifically the fact that we've been positive in Brazil, and that's been wrong so far this year. So if I were to put up a chart, it would make me, it would not look good at all. Definitely over the last year, things would have looked a lot worse and that's definitely true. And therefore, the question for us is like, what have we got wrong? What lessons have we learned from the last year? And we've definitely been far too bullish in the near term about the stories in domestic Brazil. If you looked at sort of our performance a year ago, it looked actually fairly good against our reference index over the medium term. It definitely doesn't look good at the moment. We will send you a chart if you want one. There's one in our monthly fact sheets, should you want one.
Okay.
And we'll happily forward that to you.
All right, thank you. And well, that'll be available on your website presumably as well. Okay. There is one more question here that's come in as well while you've been speaking, from Andrew. The trust's shares are yielding 7.85%. How are dividends looking this year from your investments?
Yeah, so obviously it's up to the board, the independent board, to make decisions about dividends. We do automatically in this fund pay out 5% a year because we pay 1.25% quarterly, regardless of what the underlying shares do. So that's a decision of the board. So this is a high-yielding trust, and that's likely to continue. Obviously, I can't make forecasts of what the board will decide in the future, but we do have 1.25% paid out quarterly.
Okay, but if you looked at what you've got coming in from your investee companies at the moment,
it hasn't changed.
Is the yield looking better or worse than it was, say, this time last year?
It's that since the company. So it's really there's a couple of big variables in that, and it's really a function of whether we hold some of the very high yielding companies like Petrobras exactly when they pay out dividend. 9th biggest economy in the world. And if one sort of thinks in an emerging market basis, all of Latin America is smaller than sort of half of Taiwan, which doesn't make too much sense if one thinks about there being any relationship between GDP and market cap over the medium term. So on a medium term basis, Latin America, despite their GDP being very significant, has shrunk even more on a market capitalization basis, which we think is due to reverse somewhat. If we go to the next slide, really just some data here about Brazil that is worth remembering. Obviously, we sort of can see where inflation is compared to history. We can see valuations is something which we keep coming back to. We do think valuation is very important, and the trade balance is actually quite positive in Brazil. There's been really significant growth in agricultural exports. Brazil, as we know, is a wonderful place to grow stuff, whether that is soya, whether that's corn, and that portion of the economy is absolutely booming. It obviously employs lots of people, and that's having a trickle-down effect to consumption. So while lots of people are focused on some of the political issues in Brazil, and they cannot be ignored, the underlying economy is not doing badly at all. And in fact, we're seeing upgrades to GDP growth there, which has not actually been very common over the last decade or so. If we go forward another slide.
Sorry, so I'm just picking up on another question coming in from Peter about the relative prevalence of higher inflation rates, as your chart showed, in some of these Latin American countries compared to the UK and Europe, and he particularly mentions Brazil. They're consistently higher, so the Forex exchanges is going to put pressure on anybody investing in GB pounds into a fund such as your own. So you've got a bit of a natural headwind there. And
yes, totally.
He just asked, how would you reflect on this?
Yeah, that's totally true. When we think about returns, we're not thinking about returns in Brazilian real. We're thinking about returns in dollars, in a hard currency.
Yeah.
We don't think about returns in peso or real or Peruvian sol. Our focus is on returns in dollars. So we absolutely think about this. We fully accept that over time, the real should weaken a little bit against the pound, not quite as much as it has done recently, and a little bit against the dollar. But one is more than compensated for that, hopefully, in a normal environment by some of the better growth that that country is able to deliver. So it is something we very much focus on. And I think I made a comment earlier about us having a macroeconomic process, the way we think about stocks. We're not just investing in stocks. I think I mentioned earlier that we focused on the politics, the macroeconomics, the fixed income, and the currency. So our view would be that from here, the Brazilian real probably should strengthen a little bit. But you're quite right that on a 10-year view, the Brazilian real is likely to weaken against the dollar. Slightly less true for the Mexican peso, given its historic, fairly low levels of inflation. But you're quite right. Currency is absolutely critical. So it is a headwind, but we think that headwind is more than offset by some of the growth we see in these countries.
Okay, thank you.
If we look at Mexico, the reason, and I think was asked earlier about tariffs, Mexico has overtaken China as a key exporter into the United States. Mexico, anyone that's been to part of Nuevo León in northern Mexico, anyone that's been to some of the really vibrant cities there will know that it's really difficult to find a warehouse. It's really difficult to find workers. The place is absolutely booming. Manufacturing, all sorts of goods for export into the United States. There's obviously a free trade zone, as I highlighted earlier, between Mexico and the United States, and workers get paid an awful lot less. And there are very easy ways of moving goods from northern Mexico into Texas. So it shouldn't surprise one that the story of nearshoring or friendshoring is a very active one. And as I mentioned earlier, I think it's likely that Trump, with all his comments, is likely to prefer trading with Mexico rather than trading with China for all sorts of political reasons. Mexico recently elected a new president. They have an election every 6 years, and they elected a very intelligent lady to replace the prior president. Mexico now one of the few countries in emerging markets with a leader who is under 70. It's a truly sad reflection on most emerging markets, despite having young populations, that the vast majority of the leaders of emerging market countries today are men over 70. Nothing wrong with being a man over 70, but not necessarily a very easy job to be doing. And I think it's great credit to Mexico having elected a younger leader for a younger population who is highly intelligent. And I think she's going to do potentially great things for Mexico going forward. If we go over to the next slide, just some wonderful pictures from some of the places we've been during the course of the year. Not all of them, whether that is in the Senate building in Brasilia, where I was about 2 weeks ago, whether it's Guyana, a place that not many people invest, whether it's Ecuador, whether it's colleagues of ours in Argentina. It would be fair to say that during the course of this year, we have visited Mexico, Costa Rica, Panama, Ecuador, Peru, Colombia, Chile, Argentina, and probably one or two others, Brazil, I guess, as well, quite a few times. So we spend a lot of time on the ground looking for really interesting places to put our clients' capital. And it's absolutely critical we do spend time on the ground. And when we're on the ground, it's not just about meeting, as I said earlier, the customers, the suppliers, the competitors of the companies we invest in. We spend a lot of time seeing people that others do not, whether that is seeing trade unionists, whether that is seeing, or whether it's speaking to the environmental agencies that regulate mines. It's really important for us when we're investing in a country. We are not just investing in the country, we're investing in the society. And it's critical for us to understand all portions of society, whether they necessarily like capitalists or not. Had a great meeting this year where one politician who was, dare I say it, from the far left in that particular country, told me that I was not welcome in his country and that I should go home. And I said to him, did he mean this at a personal level or at a corporate level? And he said, well, no, of course, I quite like you at a personal level. But at the corporate level, we don't want any foreign investors here. Luckily, that gentleman, as nice as he is not really in a position of power, but it's important to hear these perspectives, even if they're not very comfortable, to help us understand the countries. Let us go on one slide further. Just a little bit of the macro outlook, quite a lot of data on these slides about what's going on in these countries. The bottom line really across all these places is that inflation is likely to be heading down, and interest rates, which are very high in all these places, are likely over the next 2 years, not necessarily over the next 2 months, to be heading down, which should be supportive of the markets. As was mentioned in a question earlier, there's been big outflows of these markets as people have put their money into fixed income, as people have taken their money and spent it elsewhere, and as people have invested or gambled on all things like Bitcoin and other investments globally that look to have done better over the near term. My guess is that with a little market rally, people in these countries will be once again attracted to their own countries, and they, in all likelihood, will be the first buyers of these markets. It won't be foreigners, it will be locals buying their own markets that they've been primarily absent for much of 2024 and even some of 2023. If we go forward one more slide, just a reminder of the world we live in today. It is a world split into three, between the West, call it the EU, the US, the UK, the East, call it China, call it Russia, Iran, North Korea, and that's sort of the West and the East. And then you have the guys in the middle, who we'd call the neutrals, and that's most of Latin America. We can see it in voting in the United Nations. We can see it in all sorts of areas. And the reality of the world today is very different to the world of the last 15 years or the last 30 years. And that is the neutrals, the guys that can trade with both West and East, are doing really well at the expense of the West and the East. And we see this as we go across emerging markets, so that in Mexico, the country is able to attract investment from both China and America. The same is true in Brazil, and these countries have good relationships with both China and America. Whereas, as we know, relationships between China and the US are fairly fraught. Relations between the EU and China are fairly challenged, and we don't really see that changing very quickly. So what we're seeing is companies from the US perhaps a little cautious about investing in China, much happier to have factories in Mexico. Companies from China, a bit scared about investing in the US, but very happy to do their business in Mexico. And that really is a structural change to what we've actually experienced over the last 30 years. So that the guys in the middle, the neutrals, be they Mexico or Brazil, and when we're talking about Latin America, or whether that is Southeast Asia, whether it is the UAE, these parts of the world are doing really well. They're absolutely booming. It's not good that the world is split into three, but these countries are absolutely benefiting from that trend. And if we go forward one slide, just a reminder of our relative preferences within Latin America. The portfolio has to add up to roughly 100. We can be slightly leveraged, but not massively so. So today, strong preference for Brazil and Mexico. It's not that we really have anything against Argentina or Panama for that matter. It's just we can't actually be long everything. Definitely less preferred would be Colombia, where the finance minister has just had to step down, the second finance minister in a year stepping down, and Peru, where the range of investment opportunities at the moment for us isn't so exciting. So nothing against many of these countries, but we just can't be long everything at the same time. A strong preference for the markets of Brazil and Mexico, which have done so badly during the course of 2024. Next slide. An exciting dividend policy, as we highlighted at the beginning. We pay out, not the beginning, sorry, earlier. There's a regular quarterly dividend of 1.25% paid each calendar quarter. So you will be picking up 5% dividend yield from this fund if you hold it during the course of the year, because that makes it a bit more attractive than some of the other investment trusts. And I think in closing, and this is the last slide before we perhaps have some more questions, it's really sad that we are the last investment trust investing in Latin America. It's a reflection of how badly these markets have done for so long, that we are the last person standing. And that probably tells you this is not necessarily a bad time to be investing. When everyone's very excited about an asset class and lots of investment trusts being formed, perhaps that is towards the top of the market cycle. When we are the last man standing, it tells you something about the how many investors have already left and the cheapness of these assets, and that's probably a good time to be investing. So I look at the region with a sense of optimism, a sense of positivity. I look at positive developments in Mexico. I look at growth on the corporate sector in Brazil. I look at the political changes that we've seen, which are really positive in Argentina. I look at some of the great opportunities in natural resources in Panama and Ecuador. And yes, there are risks. Yes, there are political challenges in all of these places. But at career relative lows, these markets look very exciting and attractive to me.
Thank you, Sam. I've got another question coming from Johan here about Uruguay. He's just interested to know if you've explored any interesting businesses operating in Uruguay at all.
Absolutely. I forgot to mention being to Uruguay. Sorry, so thank you for mentioning that. We've recently had a general election in Uruguay. Uruguay is actually where there's a lot of technology innovation going on. Lots of the very smart technology investors from Argentina and Brazil and elsewhere in the region have congregated in Uruguay. At the moment, we have no direct exposure to any of those companies, but there's definitely a range of really exciting companies there that we would like to have exposure to at the right price. So we have very much been to Uruguay, looked at some of the investment opportunities in Uruguay, and I would guess that at some point in 2025, we will have exposure to Uruguayan names.
Okay, thank you. One more for me, just on some of the stats at the front end of the pack again. You mentioned that I think the assets under management in this fund are about $140 million. And I seem to recall you said strategy assets under management, $600 million. Sorry, $740 million in total. So I was just wondering, where are the other $600 million?
I'd love to say my Swiss bank account. That's not true, sadly. So Swiss bank accounts aren't very good these days. No, actually, it's in our UCITS fund, which is similar. We sort of put it in the same strategy. It's a Latin American strategy, but it's not run exactly the same.
Are you involved in managing that one,
yes,
or is that a separate team?
No, I'm the manager of that as well.
Okay, all right. Thank you for that. Well, we're all out of questions, and we're hard up against time. So thank you, Sam, for taking us through that at a good clip and answering all the questions as we went.